Hello. My name's Gavin. Welcome to M Trading's webinar. So let me start off telling you about myself. My name's Gavin. I work in the City of London, UK. We work on a trading floor. We do market analysis along with actual trading. So we do actually trade a portfolio, a fund, along with providing market analysis and education behind understanding the fundamentals, technical analysis, risk management, and psychology. Today's focus is specifically market analysis and technical analysis, but not only just technical analysis, but we're going to look at correlation. So how does correlation take part in our market analysis, which is the main topic. Yep. Okay, let's get started. So we're going to look at correlation, but not just correlation between different asset classes. When we're talking about asset classes, we're talking about the stock market, bond market, the commodity market, and the FX market. But also there's correlation within each asset class. So with each currency pair, along with commodities and so on. So the first key point I want to mention is that to remember that correlation plays out through all markets. In a way, the global economic and financial industry is, in a way, positively correlated. But certain asset products may be positively or negatively correlated. So that's what we're going to break down into. Okay, so we're going to focus mainly on the FX market, and then I'll bring also into it different asset classes correlation. The first key point I want to say is FX market. So how do I go about looking at correlation between FX market? It does come under technical analysis and risk management. The first key point to mention is I'm looking to take, well, let's start off with volume. Okay, volume is an important indicator. So on the chart, when we look at the chart, there is one key point that I want to mention, which is I can draw it out for you guys just to give you a better understanding. When we're looking at asset price, so we're looking at a couple of key indications there. First, we're looking at prices. We're looking at all of this. This is prices. Yep. And at the bottom here, that's over time. So all of this is over time. So we've got an understanding of what's taking place during these periods at what current prices. So we're looking at valuation as we go along over the time period. But in addition to that, there are three other pieces of information we need to know. One is the momentum of the market, which is we start off here, we're starting off at this high over here, we're at this lower currently. So overall, we're in a downtrend. Yep, that's the next point. That's the first point. So that's momentum. Think of this as the momentum of the market. The next key point I want to mention is volume. When we're looking at volume, it will be generally as this, a tick volume on the chart itself, underneath the chart. So that will give us an idea of how much volume is traded in this market. The more volume, the more liquidity there is, the better technicals work. Always remember that. And the next part of this is volatility. So we don't see the market going from this high to this low in one price action move. What we do have is in between volatility, such as this. This is what we're seeing here. That is market noise, volatility in the market, fundamentals taking place, trades being bought and sold at different price levels. So those are three additional indicators that you need to know on top of the price and time period. Yep. So let's delete all of this so you have a better understanding. Next key point I want to mention is that's our volume. That's our volume indicator there. Yep. Next key point I want to mention, in the FX market, it is very difficult to have an understanding of what is the true volume. It's very difficult to find true volume. For the first reason is the amount of volume that's traded. Now, if I say to you that on a daily basis, 5.6 trillion is traded in FX, that is huge, guys. So every single day there's about 5.6 trillion dollars. Let's place that in dollars. That is the amount that's traded in US dollars in FX. And if you compare that to, say, a local stock exchange, so if we take the New York Stock Exchange or London Stock Exchange, the comparison is those stock exchanges are traded on a daily basis between 12 and 20 billion. So when you're comparing the two, you can see how significant the FX market is. That's one point. The next one I want to mention is the FX market. It goes through multiple exchanges because it runs 24 hours, 5 days a week. It runs through multiple exchanges. So you have the London hours, and then you have the New York hours, then we have the Asia Pacific hours, and we have Australia and Japan, and then it goes round as that. So the market is trading constantly 24 hours. So to take all that data, all that volume that's being traded, and compile it into a data source that we know that, okay, this is the true volume, it's extremely difficult. You can find certain FX currencies, individual currencies, so just the euro or Swiss franc or the US dollar on the futures market on the Chicago Mercantile Exchange, and understand on the futures market how much volume there is. But to represent the true volume, it's extremely difficult to get that information. What we can get is through our brokers. So M Trading will have their own volume indicator, and that volume indicator will give us a smaller representation of the true volume. So there is that benefit. Yep. But if we can't see the true volume in FX market, how do I know which asset is traded, which one's trading with the most movement? So which one is the biggest mover compared to others? Yep. So what we need to do is work out on relative strength. So we're trying to find out the individual currencies' relative strength. So the way to do that is look at cross currencies. So look at cross currencies and have an understanding of, is it moving higher? If it's moving higher, by how much? And we can have an understanding of where's the strongest currency and where's the weakest currency. Once we have an understanding of the strongest and the weakest, we can pair those two. We want the extremely strong currency and we want the extremely weak currency. Pair those two up, and that's where we would expect the biggest move. So, for example, if I look at cable. So what I'm looking at cable, let's go to a, say, 15 minutes time frame. 15-minute time frame, and what we're seeing in cable, all I want to know is market direction. So what is that market direction? Okay, so from that high down to this low, so the direction is down. So we know now that sterling is weak, sterling is down, dollar is strong, so dollar is up. Just from looking at this chart here. Yep. So once we know that, okay, now I know sterling's weak, dollar's strong. Then we go into, for example, suppose if I wanted to compare another asset, go into a 15-minute chart. Okay, this is what I'm seeing here. So again, let's do the same comparison. So if I saw two setups, so we've now seen cable, so GBP USD, and I'm looking at Euro USD, and they're both in a downtrend. Which setup do I take? I don't want to take both because they're both dollar related. They're both dollar based, not based but dollar termed. Remember that the first currency you're viewing here is your base currency. That's always to the value of 1. And the secondary currency, this one there, the US dollar, is your term currency. That is what's being reflected on price. So for €1, I could receive $1.17 US dollar. Yep. So as we've seen, okay, from this high down to this low, a move down. So we now know again that we have euro weakness, so euro is down, but the dollar is up. So overall, dollar is the strongest currency out of the two. Excuse me. So yes, dollar we know with cable and euro dollar that we know that dollar is the strongest currency, but euro and sterling is weak. Now I'm looking to choose one of these pairs to trade. How do I go about it? The last thing I want to do is take both these trades. If I took this short and I took cable short, suppose if dollar becomes weak, we've currently got live right now Janet Yellen speaking, and she is naturally obviously dollar correlated, so whatever she says could have a significant impact in the US dollar. So therefore, if all of a sudden she says something extremely negative for the dollar, we could see dollar come off significantly, and then we would see euro and sterling increase in value, so they will go up. So if I take both trades, I could be stopped out in both assets. And if I'm taking 1%, 1% in both, and I've got a daily risk of 2%, I've hit my limit. I can't trade for the rest of the day. And the reason why I can't trade for the rest of the day, because I went over risk on the same asset. I'm trading the dollar. So therefore, I wouldn't take both trades. The idea is, let's look for one. So what would I do? Okay, what I need to do is look at euro with sterling. So we need to look at euro with sterling. So let's go into euro sterling, go onto a 15-minute time frame. Let's go to the most recent price action. Let's just move it all the way along. Okay, so what are we seeing in euro sterling? Remember, let's go through that same process again. We can start from this high down to this low. Remember, the base currency, which is euro, that's set to 1. Sterling is our term currency, which is reflecting the price. So for €1, I could receive 87 pence. Let's go with 87 pence. So what I want to check now is that, okay, I know we've moved from this high down to this low. Which one's strong? Which one's weak? What do you think, guys? So naturally, euro is down. So euro is down, sterling is strong. So sterling's our term currency. Sterling is strong. Is that correct, guys? Is that correct, guys? That is correct. Yep. So moving on from there, so we now know that, okay, the chart's moving down, so we're seeing euro weakness and we're seeing sterling strength. What do I do next? What do I want to do? I want to have a look at which asset? Which asset do I want to look at? So if I know now that, okay, so let's put this in order. Let's put this all together into one simple chart over here. Okay, so we've seen that both. So if we're looking both at GBP USD, so GBP USD over here, and then we have the Euro USD over here. Looking at both these assets, we know they're both Euro weak, Sterling weak. We know this is the key currency. Dollar is the strongest currency. So dollar is the asset I'm looking to buy. I'm looking to buy dollar. Then we need to check out of these two, which one do I want to trade? Which one do I want to trade? Do I want to trade sterling or do I want to trade euro? Then therefore we look at euro. Oop, let's try that again. So this is moving down such as this. This is euro sterling, so euro GBP. So this is euro GBP, it's moving down, so we know there's euro weakness and sterling strength. So in the order, so dollar is stronger than GBP, put it in that way, and then GBP is stronger than the euro. So therefore, the best asset to trade is look to sell euro and buy dollar. So we're looking at euro dollar. So euro dollar would be the best pair to trade. We would exclude sterling. That's in the middle there. It's not as weak as euro. I want an extremely weak currency to pair up with an extremely strong currency. So euro dollar would be the best setup. Once I've done this relative strength, guys, it's very easy to do, guys. You could do this among many other pairs. Then I'll go into my euro dollar chart, and now I'll be looking for the best setup. So you can naturally see already, if you compare this to cable, you can see how volatile cable is. A lot more volatility involved in cable. You can in fact zoom in, a lot more volatility in cable, whereas euro dollar, almost a straight line down, a very nice trendy market there. Yep. Okay, so once I've defined this, then my next step is, okay, do my market analysis. My market analysis will be as simple as, let's have a look here. There we go. So just looking at this asset here, we could see that euro dollar is on a short trade. So a short, we're looking for a trend line. Let's take a trend line from these highs, place it above these highs, so we can include that high and the most recent high, something similar to this. So that is my downtrend line, multiple touches to this downtrend line, looking for support and resistance levels. So we can also place that key level here, where you have this as a support level and that as a resistance. And we're looking for the next retracement back. So we're looking for that retracement back. We're looking for a retracement back to this region here. So we're looking for a retracement back to in this region here and look for the continuation move lower in that direction. Yep, that's one approach. Our second approach may be if we see the position switch. So if we see dollar become extremely weak and then euro strengthen, and we could also look for potentially a long position when we break through our trend line. That will be our buying opportunity there. Yep. So that varies, guys. Ideally, incorporate relative strength into your analysis, guys. Understand that would save you a significant amount of money just from understanding which pairs to trade and not take every single trade setup. You want to filter through. You want to filter through the best trade setups, looking at relative strength, looking at technical analysis, and understanding fundamental analysis. And on top of that, you want to have good psychology. Be in control of yourself, guys. The edge is you. You are the edge. A lot of people ask, what is my edge? Or what is your edge? The edge is you and how you go about your process. And also have good risk management. Yep. Okay, so let's do another correlation. So we're going to do a cross asset class correlation. A cross asset class correlation where it's going to be not positive correlation, as we're looking more at individual currency correlation, whether it's positive or negative. We're going to look at an inverse correlation, so an asset that moves the opposite or moves in positive. So we'll go with the positive one first. The positive one being, let's go into, for example, positive correlation is when you're looking at oil. So when we look at oil and it's breaking levels, it's making new highs and so on. Yep, so we have this extremely important fundamentals, guys. OPEC have recently announced that, okay, they are looking to continue with the freeze output for a short period of time until their next meetup. So we're seeing extremely bullish sentiment in both Brent oil and WTI oil. So this is going to break through a level where almost got to the 60 level, but yet just short of that 60 level, we broke above. So this is extremely positively correlated to the Canadian dollar. So if we have a look at the Canadian dollar, let's go with, so let's have a look at Canadian dollar. And as you can see, if I just move this slightly to the right-hand side, yep, so we have a significant uptrend with this asset also. Yep, so we have an extremely bullish asset here. So we know oil is doing progressively, it's progressively bullish, breaking and making these new highs that it hasn't made since mid last year. So all the way through, high highs, high lows, high high, high low. Not a high high because it's not higher than the previous high. Some short-term sentiment held this level. It held this level and it went sideways, a little bit of a pullback, and then the continuation. This being now the new high. So we're looking for the next retracement back to this range here. So I'll be placing a trend line in this direction here. So we want to place a trend line in this direction, look for the pullback and look for that continuation move higher. This is pulling back at the moment now. Other key fundamentals do have an impact on the Canadian dollar. So we do have the Bank of Canada, so the Central Bank of Canada also coming up, are speaking soon in regards to their economy, their economic growth, the GDP, along with deciding on interest rate, whether they're going to keep it the same or they're likely to increase their interest rates. So that has also dulled down the Canadian dollar. But overall, we know that Canadian dollar has been bullish, but we are seeing most recently dollar strength coming through. So we can see dollar strength coming through, but there is a positive correlation between crude oil, Brent oil, and the Canadian dollar. The key reason I'd say to that is because Canada, their biggest exports is oil. Yep. So now we're going to look at that inverse correlation. So an inverse correlation if I go to an inverse correlation, and I'm going to go with something similar to, say, let's bring up the S&P 500. So we're going to look at the S&P 500. Let me just change the template, guys. Guys, do save templates. Have a look through and save a template for your setups. So we'll go with this one. Let's hide all of this analysis. So the next key point I want to mention is, okay, we're seeing some volatility over here, but this asset is extremely correlated to the US dollar. Yep, so when we see the S&P 500 and the US indices are rising, making new highs in this direction, we're also going to see the dollar go in this direction. The reason why you have this inverse correlation is because when S&P is making new highs, you're still not going to have investors that are looking to buy into those same investments. Whereas if we see that the dollar becomes weaker, industries and companies, conglomerates are likely to use that cheaper dollar, the cheaper valuation of dollar, the most recent term, and use that money to invest in its own infrastructure, its own businesses, and so on. So therefore, you have that inverse correlation between an indice and its own currency. Yep, and that covers asset classes, guys. So we're looking at cross asset classes correlation, and then we're looking at same asset class correlation, where we've gone through some FX pairs to understand better what is their correlation, and then we've had a look at also the correlation, so a positive correlation between Canadian dollar and crude oil, but Canadian dollar is being dulled down purely because of the most recent statements that are coming up soon in regards to their economy, so Canada's economy and interest rate decisions. But then also we've covered an inverse correlationship between an indice and its currency. Another key point to mention, guys, as I'm talking about correlation, one key point I want to mention is have a look at both charts on the same time frame with the same amount of periods. So therefore you can have a better understanding of what the correlation is. But if you're a day trader, there may be less correlation as a position trader who's looking at a higher time frame from a daily or weekly time frame, daily or weekly standpoint. So therefore, a day trader may consider correlation to be less likely on a shorter time frame, such as the 5-minute, 1-minute, 15-minute time frame, but there might be higher correlation on those higher time frames, such as the daily, weekly, and monthly time frames. So yes, the percentage of that correlation does matter. Yep, there could be even periods where there might be a complete disparity between the two correlation, and that generally does happen quite often in the shorter time frame, but it can happen if there's a fundamental influence to it. Okay, and that's it, guys. That's market analysis with correlation and how to go about it. Thank you for listening. Take care, guys. See you in the next M Trading webinar.